Welcome back to The Explainer. Okay, today we're skipping the usual pleasantries and blowing right past the standard agenda because the financial story we're looking at is just way too dramatic to delay. We are prying open a mystery box right out of the gate, one that's going to seriously challenge how you think about growth, value, and the true cost of corporate perfection in the market.
1,988.32%. I know, it sounds crazy, but that is not a typo. That is the actual mind-bending 10-year return of the company we are dissecting today. If you had parked your money there a decade ago, your capital would have multiplied nearly 20 times over. It's the kind of pure, unadulterated market awe that literally makes investors salivate and rethink their entire portfolio strategies.
Which naturally leads us to a pretty massive question. Is this the market's perfect stock? Because, when you see sustained massive returns like that, it is remarkably easy to just assume the company underneath is utterly flawless. Today, we're going to explore that exact tension. We'll build the ultimate bull case based on their operational dominance, and then we're going to confront the bear case, looking at the hidden mathematical risks that are looking right in plain sight.
Let's start with Section 1, an unbelievable market run.
Okay, let's dive right into this. The stock behind that staggering number is Fabrinet, trading under the ticker symbol FN. Look at the sheer momentum they have sustained across literally every single time horizon we track. Over the trailing 12 months alone, the return is 237.27%. Over 3 years, it's 626.31%. 5 years, 642.05%. And then, of course, there's that jaw-dropping 10-year figure of nearly 2,000%. To put this into perspective, your standard, solid market returns usually hover around, 7 to 10% a year? The sheer exponential growth here just defies standard market gravity. They aren't just having one lucky year, they are compounding wealth at an aggressive, almost unbelievable pace.
So what is powering this? Section 2, the growth engine inside.
To find out if this incredible market run is actually backed by real fundamentals, we really have to look under the hood. It's one thing to just make money. It's a completely different thing to make it efficiently. Fabrinet's 5-year revenue compound annual growth rate is a very healthy 17.91%. So they're growing their top-line sales consistently, right? But here's the kicker. Their 5-year net income CAGR is an incredible 24.73%. Fabrinet isn't just growing its revenue, it's scaling profitably. Their profit growth significantly outpaces their revenue growth. This means that with every new dollar coming in the door, they're actually keeping more and more of it as pure profit.
And all of that operational efficiency culminates in a return on invested capital of 24.16%. At over 24%, Fabrinet is demonstrating truly elite capital allocation. They're taking the cash they generate, pumping it right back into the business, and generating massive, consistent returns on every single dollar. This completely solidifies the bull case. Fabrinet is an absolute machine when it comes to operational efficiency.
Moving on to Section 3, a bulletproof balance sheet.
Now, high growth often comes with a dark side, doesn't it? Usually, it's in the form of massive debt used to artificially fuel all that expansion. But, and this brilliantly illustrates what true financial health actually looks like, their debt-to-equity ratio is absolute zero. None. They are generating all of that historical growth and profit without relying on a single cent of borrowed money. Pair that with a current ratio of 2.68, meaning they have nearly 3 times as many liquid assets on hand as they have liabilities due within the next year. It's just pristine corporate health, plain and simple.
But we need to look at the other side of the coin. Section 4, the valuation reality check.
So we have a company with explosive revenue, even faster growing profits, elite capital efficiency, and a totally flawless balance sheet. Sounds perfect, right? Well, here is the dramatic plot twist. In the stock market, you don't just buy a great company, you buy it at a specific price. Based on standard discounted cash flow metrics, Fabrinet's fundamental fair value is calculated about $151.75. But the current trading price is $684.76. The stock is trading miles above its fundamental fair value. You are paying an extraordinary premium for all that operational perfection we just talked about.
Which reveals a massively negative margin of safety, minus 351.24%. Not only is there zero protection here, but paying this much for future cash flows carries immense valuation risk. Even with a perfect balance sheet, this leaves virtually no room for error. If their hypergrowth slows down even slightly, the downside could be absolutely severe.
To contextualize exactly how expensive this stock has become, let's just rapid-fire some of these skyrocketing valuation metrics compared to Fabrinet's own 5-year historical norms. Their PE ratio sits at 65.59. That is 107% higher than its 5-year average. The price-to-sales ratio, 6.3, up 109%. And honestly, the most staggering one, the price-to-free cash flow ratio is an astronomical 244.42. That's 171% higher than their usual average over the last half-decade. The market has priced in not just perfection, but endless perfection.
So the crucial point is this. While the stock price is soaring into the stratosphere, the actual cash-generating power has hit a serious snag. While their 5-year free cash flow compound annual growth rate was a modest, positive 2.88%, their trailing 12-month free cash flow growth has shrunk drastically, down negative 67.75%. So despite the net income growing on paper, the actual free cash flow, the true lifeblood of long-term intrinsic value, has severely contracted in the near term.
Which brings us to our final question to ponder today. It is a phenomenal company, absolutely, but at what price? We've seen the undeniable tension here. Fabrinet possesses flawless operations, zero debt, and historic momentum, but it's paired with a terrifyingly extreme valuation, demanding absolute perfection from a company whose free cash flow is currently contracting. So is a nearly 2,000% return a signal of invincibility, or is it a glaring warning of a valuation ready to snap back to reality? That is the mystery box you now have to solve. Thanks so much for joining me on this explainer today, and as always, keep questioning the numbers.